everyone. I'm excited to share with you a brief overview of our Alternative Income Fund 3. Before we dive in, I want to just mention that when my father and I started our company, SMK Capital Management, a little over 13 years ago, our focus was on providing investors with diversified investment offerings, and that really remains the case today. We like to diversify and spread capital across operating partners, multiple asset classes, different regions, and simply put, in our view, diversification helps reduce risk. Now, with all the market volatility out there today, rising interest rates, inflation, recessionary fears, we've been working very hard for a little over 5 months now to build our most recession-resistant and diversified fund to date. So what we're not trying to do here is hit a home run. The purpose of our fund is to reduce risk, to withstand market volatility, and provide you with consistent income and growth. So what I'm going to do, I'm going to share my screen and spend about 10 minutes reviewing the asset classes that we've targeted for our fund, along with the projected returns. So let's go ahead and begin. Okay, our fund plans to invest in self-storage facilities, mobile home parks, triple net industrial properties, and also a small portfolio allocation into more fixed income assets, including ATMs and private real estate debt. Again, the goal here, diversify, spread capital across recession-resistant assets, and reduce risk. All right, the objective of Fund 3 is to build a diversified portfolio with an attractive blended return of income and growth. And we're going to do that by having different portfolio allocation to the income producing assets. So you can see here about 20 to 30% of the portfolio will be invested in more of the fixed income assets like ATMs and private real estate debt. Meanwhile, we're targeting for 70 to 80% of the fund to be allocated towards the assets that provide income and growth. That includes mobile homes, self-storage, and triple net industrial. Now, this allocation just allows us to earn strong cash flow beginning in year one, where we can beat inflation, and it also gives us enough room for ample growth on invested capital. So let's first review the income-generating investments. We'll start with the private real estate debt fund that we've targeted. This is an established debt fund where our capital is being lent as part of a large portfolio, predominantly to borrowers who are building multifamily properties across the country. The loan sizes range between 5 and 100 million. The sweet spot is really 20 to 40 million. These are short-term loans, usually less than 36 months. Now, once the property is built, the borrowers will refinance or sell the property and then pay off the loan. Now, the debt that we are invested in is a first position lien, which basically means that we are the bank, and this is a much lower risk investment versus our typical equity investments. And the fund that we're investing in is already very well diversified with 62 loans in the portfolio. Next, our operating partners in this fund just have a stellar track record, one of the best in the business. They've to date have had 196 loans paid off, totaling over $4 billion with no losses. And the fund has been providing investors with consistent quarterly returns of over 10% since it was opened in 2015. Okay, our second targeted income investment is into an ATM fund with a repeat operating partner that we've had great success with for over 4 years now. And for those of you not familiar with ATMs, they basically provide us with consistent cash flow of around 25% a year. But ATMs are equipment. We're investing in equipment. They actually depreciate, so there is no growth. Now with that, we also have an advantage where we get very attractive bonus depreciation, which is expected to provide us with significant passive losses in year one. So in summary, these income investments are projected to provide our fund with consistent annual income beginning in year one, and really with a limited variability of returns. Okay, now let's review the income and growth generating investments that we've targeted for our fund. We're planning for these opportunities, as I mentioned before, to make up around 70 to 80% of the portfolio. The first is a triple net industrial sale leaseback portfolio. Now, this portfolio targets private manufacturing businesses. And for those of you not familiar with the business model, the sale leaseback process involves a company selling their real estate to us. They're occupying that real estate, and then they lease it back to us as the tenant. And so this creates 100% occupancy at acquisition, provides lower risk. A lot of times the properties are actually, the companies, I should say, are being acquired by private equity groups. Those groups want to own the business, not necessarily the real estate. So they'll look to sell the real estate and continue to operate and grow the business. Now, one of the advantages of this asset class and its structure is it's one of the best hedges against inflation. And some of the reasons why. Tenants are responsible for paying property level expenses. This includes taxes, insurance, utilities, building maintenance. All those expenses are the responsibility of the tenant. That's all written out in the lease agreement, making it an absolute triple net lease. The portfolio that we've targeted in this space, it already includes 6 properties in 4 states, and we're anticipating it's going to continue to grow to about 15 properties. So just within this asset class and this sector, we're going to have a lot of diversification. Further, a few more important points. The leases in the portfolio thus far are all long-term 20-year leases, very attractive, lower risk, and they have built-in rent escalation. So each year, the rents go up 2 to 3%. So you've got rising rents on a predetermined schedule, and you've got, essentially for us as the asset owner, the property owner, we have 0 expenses. And so you create a very inflation-adjusted hedge to today's marketplace. It's very hard to find ourselves in a situation where we have an investment where the expenses aren't going up. That is something that has hurt a lot of commercial real estate and residential real estate over the past year and a half. Lastly, we're looking at the debt on the properties, very conservative. We've got 70% LTV, all fixed rate debt. The interest rate is anywhere from 5.75 to 6.5%, with the going in cap rates around 8%. So that's a very healthy spread, great way to start an investment and produce positive cash flow. So far, this fund has been providing investors with 7% cash flow. That was the first quarter distribution in 2023. Overall, we're looking for it to provide us with 15 to 17% IRR, about a 2x equity multiple, with an average cash on cash of over 8% through the whole period. Now, lastly, our operating partners here have a very stellar track record. They've had 24 investments go full cycle. They've provided investors with an average annual ROI of over 20%. Okay, the next income and growth investment for our Alternative Income Fund 3 is into mobile home parks and self-storage. This is through a portfolio, again, with a repeat operating partner that we continue to have great success with. Now, we continue to focus on mobile homes and self-storage. They were the main asset classes in our previous alternative income funds. They're some of the most recession-resistant asset classes due to the fact that they're very lowly correlated, some even say uncorrelated or inversely correlated to the economy, where we can see demand increase during economic downturns. Okay, so the portfolio that we've targeted here was just recently opened. Our operating partners have since acquired 4 self-storage properties in 4 states. The total's more than 1,000 units. And they are also in due diligence on several mobile home parks that may also be added to the fund in the near term. Now, our operating partners here focus a lot on in-place income, where the properties are generally producing positive cash flow day one, but they're also very heavily looking on value add strategies across their assets. That can be through institutional management, property renovations. They focus a lot on buying from mom and pop owners, some of which are just using archaic methods to manage their assets, including literally writing down leases and expenses on pencil and paper. And so we're expecting this investment to continue to grow to over 200 million in equity and over 12 properties. So really, again, highly diversified within these two asset classes. Project level projections for the self-storage portfolio thus far are 25% IRR and a 2.6 equity multiple. So very attractive returns. It's also important to note we're in due diligence on 2 additional mobile home park portfolios with different operating partners. It's too soon to say if we're actually going to invest in them, but if we do, they'd be added to our fund. All right, let's review the projected returns for investors. We have 3 class shares, typical of our investment structure. Minimums of 50,000 for Class C, 250 for Class B, and 500 for Class A. What you'll notice here is that we simplified our cash flow and profit splits to really reduce the amount of administrative and accounting work behind the scenes. So what we've created here is just a straight cash flow split. There's no preferred return, there's no hurdles. So investors will earn 80 to 90% of the net income that comes into our fund from operations and rents, and also from property sales. And there's no limit on the upside. And SMK would earn the difference of 10 to 20%, depending on the class share here. Now, this is a higher split to investors than our typical preferred return structured investments, which usually have a 70 to 80% split to investors. And then we really created this structure to incentivize us to ensure that we're selecting high cash flowing and highly profitable investments. And as I mentioned, it really helps keep the fund accounting a lot more straightforward. So the result to investors, you can see the returns here, is an average cash on cash of 7 to 10%. That is from distribution income that we plan to do quarterly, an equity multiple of 1.55 to 1.7, and an average annual ROI of 11 to 16%. Now, we've also lowered our management fee. You can see that here from typically 1.25% for our funds. We've dropped that down to 1%. And we have also a one-time acquisition disposition fee of 1%. Now we're projecting our investment duration to be about 5 years and some capital to begin being returned in years 2 through 4. That would come through some of the underlying properties being sold or refinanced. As I mentioned, we're planning to do distributions quarterly. And then you can see the projected annual cash flows starting in year 1 of 4 to 7%. That's net to investors. That gives us some time to actually build the fund, to go out and make these investments and start creating those distributions. We expect that to increase beginning in year 2 from 7 to 9% for year 2 and 3. And then year 4 and 5, 8 to 10% net cash flow to investors. Okay, well, I appreciate your time taking a moment here to listen to everything, an overview of this fund. To learn more, you can log into our portal on our website. We've got the full investment summary along with our operating partners, an overview of them, the portfolios that we're going to invest in, really dives into all the details on the who and the what we are investing in. So as always, please reach out with any questions. We're happy to help. Thank you.